Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another video. And the title of this video is You Will Never Save Money Again. I probably should put if you have debt, right? Um, so that's what we're going to do, not save money, pay off debt using something called velocity banking. So, what is velocity banking? Basically a debt payoff strategy where we don't save money and we throw all of it into something called a line of credit. So somebody in the last video complained about how 13 grand is not a realistic number for the average American income, and I don't think they're a veteran of the channel. It seems like they're new because when we talk about the average American, we're not talking about income. We're talking about banking style, right? Banking style. And so what's the difference between here and here? Well, what we're trying to show is that with the same income and the same expenses, can we get rid of our debt easier, right? And another thing that people don't seem to realize is that with our debt, right, our debt is always going to be proportional to our income. So there's no way that we can have all of this debt unless we have a certain amount of income, because there's going to be a certain saying that you may not be aware of, but it's very important to remember that banks don't lend money to people who need it, because people who need money don't pay you back. Okay. So let's go ahead and get started. Velocity banking, what is it? Um, so the way that I like to present it is this, right? So I like to hide this little velocity banking column, and I just say, hey, friend, family member, let's say you make great income, but you happen to get yourself into a lot of debt, right? So 8 credit cards, an auto loan, student loan, a mortgage, and then you have $2,500 on top of that on your month-to-month expenses, food, gas, insurance, all of that, right? If you want to get out of this hole when you only have $1 left in your leftover checking and savings, do you need to make more money? And everybody will pretty much say yes, right? So what we're trying to do is just show, hey, same income, same expenses. What happens if we don't save our money? Okay? And then we increase this thing called our cash flow. See, the way that the average American style of banking is different from velocity banking is our relationship with our checking and savings, here and here, right? So the way that we think about the checking and savings, the average American style of banking, is that it is the final destination of our money. Okay, whereas velocity banking, it is just seen as the middleman of our money. Meaning, when money comes in, it just goes right out into something called a line of credit. So, what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. And then you see this button right here where it says transfer funds. Well, if you want to dump money into your checking account, it's so easy. You just click line of credit to checking and then transfer funds, and then bam, you'll have money in an instant. And by the way, if you don't know who I am, I paid off a mortgage in 2 years and 9 months. And not only that, I have over $739,000 in credit cards and lines of credit. Okay, so just be aware of that. All right, so we're going to assume we have access to $260,000 line of credit free and clear. So think of it as a giant credit card. But if you only had $1 left over, would you really be able to get a $260,000 line of credit? The answer to that is probably not, because you don't know the secret if you weren't aware of this, is that banks don't lend money to people who need it, because people who need money are considered to be a giant risk, and people who are a giant risk don't pay you back, right? So what they're looking for is a safe bet. So what's the main importance of me telling you this is that in order to get all the lines of credit, kind of like I did, you just got to go to a bank when you don't need money. You don't go to a bank when you don't need money, okay? All right. Wait, did I say that right? You don't go to a bank when you wait, okay, let me say that again. You don't go to a bank when you need money. All right, so what we're going to do is just consolidate some of our debts to increase something called our cash flow. Done this a million times. I'm sick and tired of doing this because it's like, oh, I got to go to sleep. But then, people want to see me do the velocity banking stuff. So here we go. So in order to figure out which debts to move into the line of credit, we have something called the cash flow index. Basically, you have the balance of the debt divided by the payment, and then what you do is you essentially put them in a ranking system, and the lower the number, that's the ones you want to move into the line of credit, whereas the higher number means that you get less bang for your buck for moving the debt into the line of credit. So for example, if I decide to pay off the mortgage first, that literally means I have to give someone $350,000 to only get $2,000 of cash flow in my life back. Whereas if I tackle the student loans, $175,000, I could get about $2,000 cash flow back, right? So which one gives you more bang for your buck? Obviously this one, and the lower the number, the more bang you get for your buck, right? So what we're gonna do is start off with these credit cards, okay, with these low cash flow index numbers. So that'll be 5, 8, 15, 27, 37, 10, 35. And then what we're gonna do is sum them up, and we see that we have $137,000 of credit card debt, right? So 137,000, and then what we're going to do is we're going to do this. So 0.0000000, right? And then voila, we have $1 checking and savings that magically turn into $4,451.83. This is where the magic happens, right? So you take a look at this, you're like, wait a minute, same income, and we just shuffled around expenses, and somehow this $1 turns into $4,451.83, right? And then the final step is easy. You just put paycheck into line of credit, expenses out, and then the cash flow should bring down the balance of the debt. So let's go ahead and do that. I2 plus 1, and G2 plus H2 minus what's our cash flow, 4451.83. And then the interest is based on the average daily balance multiplied by the interest rate. And then you divide by 12. Oopsie. I'm going to do this right here. Alright, so now what we're going to do is copy and paste. And then we see that in 35 months, this gets paid off, right? So let's go ahead and mark this down as one of our milestones, which is 35 months. And 137K paid off. Okay, and then we have the auto loan, student loan, and the mortgage. So it's going to be 35, 35, 35, and then same deal, use the cash flow index. So I'm going to move this into the line of credit, right? So it's going to be here, plus 15650.5, okay? And then what we do is we get this extra $660 of cash flow, and we increase our cash flow here. And then here, and then 5112.32, and then bam bam, and then 38, 38. So 1, 2, 3, and then 38. So 38 months. So now it's 137 plus 35. That's 172K. All right, and then we have the student loan and the mortgage. So at 38 months, we just do the same thing over and over again. All right, and then let's go ahead and move the student loan into the line of credit. I'm going to do that right here. Alakazam, wablam, whoopsie. No, that's not it. So now we just move 132,961.83, and then this is now an extra $2,000, and then now $7,000 in cash flow. So minus 7,189.6. All right. Oh, excuse me. I think I'm burping. 58 months. That is paid off. So just 20 more months until student loan is gone. And we have 172 plus 175, and then that's 347K. Okay, and then the mortgage is 350,000. So at 58 months, what's the balance of the mortgage? It is 58 And then you see right here, right? You see right here, current balance is 326,000. So let's go ahead and use our velocity banking calculator. So there's two ways we can pay this. We just directly overpay the loan with the cash flow, or you might want to use a line of credit, but I just want to show you here that even if you use a line of credit, you'll still be safe, even if the interest rate is different. But most important thing to understand, okay, is that with the 30-year mortgage, you got to be a little bit careful. And the lower the interest, or the bigger the difference with the interest rate and the line of credit, if you're going to move it, it makes a big difference. But if you use something called chunking, right, which is moving a little piece of loan into the line of credit, you should be fine, regardless of the interest rate, right? So let me just kind of go here, and what did I put? 326,623.2. 326,623.2. And then let me just kind of redo this. So our income is 11,788.03, 11,788.03, and then our expenses is 2,500. And then what we're going to do is just move a piece of the loan, we'll say $12,000 chunks, into the line of credit. Bam, paid off in 3.3 years, saved $270,000 of interest. So let's go ahead and do that. All right, so 58 plus, or divide by 12 plus 3.3. And that's 8.13 years debt free. Debt free. See how easy that was? That was so easy. And now we did it by not saving money. And then now at this point, if you have all your debt paid off, then the cash flow will now go into your savings rather than just being used to pay off debt. But look how far we got. Well, first it was $1, and then we're freaking out that we need more money. But when we redirect the flow of money, we paid it off relatively quickly. All the debts paid off in 8.13 years. All right, well, that's it for today, folks. Korean Lanta Mentorship did this by not saving money and then utilizing something called line of credit. Have a great day, and I'll see you all in the next video.